Hello and welcome to Switzer Investing Insights, brought to you by nabtrade. And today we're going to shine the spotlight on JB Hi-Fi's buyback. Paul.
Yeah, first of all, Peter, why are they doing the buyback? They've got excess capital, and this is a way to distribute effectively surplus franking credits back to their shareholders.
Yeah, okay. So why don't you tell us what is the difference between an on-market and an off-market buyback?
Yeah, so an on-market buyback is the way it sounds, Peter. The company appoints a broker. They just stand on the ASX and buy shares back. This is an off-market share buyback. It's done on a different basis. It's done according to some rules set by the tax office, and essentially it includes an equal access tender arrangement so that shareholders are given the chance to participate through a tender scheme. Now, the reason that it's done on this basis, Peter, is because it's a way, as I said, that the company can distribute surplus franking credits, and it becomes particularly attractive to certain types of low-rate taxpayers. And that's because the proceeds of the buyback includes both a small capital component and quite a large fully franked dividend. And that makes it very attractive to certain taxpayers. It's conducted at a discount to the market price because it only works for some shareholders and not others. And because it's so attractive to some, they're prepared to effectively sell their shares back at a price below the market price. And that's what arguably makes it fair to all shareholders, because JB Hi-Fi is able to buy back more shares at a lower price.
Which ultimately should help the share price, shouldn't it, Paul?
It should indeed.
Okay, so why don't we now go look at the main details of this buyback?
Yeah, it's a $250 million buyback, off-market share buyback. That's about 5.1% of JB Hi-Fi shares. Totally voluntary whether you participate or not, and I mentioned that it will be done at a discount to the market price. That's where you nominate a tender discount between 8 and 14%. Now, of the proceeds you get, there'll be a small capital component of $3.18, and the rest by way of a very large fully franked dividend. Now, assuming a market price of about $50, that fully franked dividend will be about $39.52. So, very small capital component, very large fully franked dividend. The tender closes at 5 p.m. Eastern Daylight Time on the 8th of April. And the result will be announced the 11th of April, with payment made on the 18th of April to successful applicants.
Yeah, okay. So who should accept?
Yeah, off-market share buybacks work, Peter, for zero rate and low rate taxpayers, and don't work for other taxpayers. So, the way to evaluate this, Peter, is we work on the premise that if you could sell at a higher effective price into the buyback than you could if you sold the same shares on the ASX, then you should accept the off-market buyback. And so for a 0% taxpayer, such as a self-managed super fund paying a pension, this off-market buyback is very, very attractive. For a mid-range taxpayer, say for example a taxpayer paying tax at 15%, that might be for example a self-managed super fund in the accumulation phase, that's where money's going into super, it's still going to be pretty attractive. But for high-rate taxpayers, it's individuals paying tax at rates over 30%, and particularly for people paying tax at 47%, that's the highest marginal tax rate. This is unattractive. Don't accept.
Yeah, okay. So, Paul, are there any other key considerations people should think about?
Yeah, now, of course, the reason why you take part in a buyback is attractive from an after-tax point of view. It's essentially, I won't say it's a tax transaction, Peter, but it's really leveraging of franking credits and the refundability in cash of franking credits for certain types of taxpayers. So the first thing to note is that, as I said, it's only going to work for some taxpayers. And secondly, that if you do accept, what are you going to do with the cash that you get afterwards, right? Do you reinvest that same cash in JB Hi-Fi shares? Do you buy another share? Do you buy, perhaps just stick the money, say, I want to reduce my exposure to the share market. So it's important to have a strategy about what you're going to do with the proceeds you get once the buyback is accepted or not. Secondly, just be careful that this buyback will be subject to a scale back. It's only small at about 5%. It's a very, very big fully franked dividend. It will go at the top tender discount range of 14%. So if tendering, I would either tender 14% or what's called a final.
Because they ask you to do that, don't
they?
You
have to nominate a price, but you can leave all that hard work to other people and say final price. In other words, you'll tender essentially what it clears at, so let the market work it out. So either tender 14% or final price. And be aware that because it's likely there'll be a scale back, you won't get all your shares accepted.
So you might put 500 in, but they might only accept 100 or 150.
Yeah, there's going to be a priority allocation of the first 100, but after that, you're likely to be a pro-rata scale back. So they're probably the most important things. But look, as always with any sort of complex transaction, JB Hi-Fi has issued a share booklet, a buyback booklet. That gives you some worked examples of different tax rates and different cost prices, and you can see the effect. And because largely this is a transaction about, which involves taxation, particularly how the benefits of this flow through from an after-tax point of view, we recommend that you consult your professional advisor or your accountant and get his or her opinion.
Yeah, that's great advice, Paul. That's Switzer Investing Insights brought to you by nabtrade. Thanks for joining us.